In this video, we're going to explore the valuation fundamentals, and then we're going to apply that concept to bonds. How do we find the value of assets? That's really the process of valuation, right? Figure out a way to find what something is worth by utilizing the risk and return characteristics of the company. So what variables do we need? What are the inputs? Certainly we need to know cash flows, right? We need to understand what cash is the asset going to provide to the investor. We then need to know when that timing is expected to happen, right? Is it earlier in the asset's life, later in the asset's life? Does it come monthly? Does it come annually? And in addition, the last thing is we need to understand something about the risk, the uncertainty with which these cash flows are expected to occur. So our basic valuation model says, look, if you want to find the value of any asset, you need to find the present value of all future cash flows. So we have a basic formula. Here we have the cash flows in the numerators, clear out to year n. So this asset has a life of n years or periods. And then we have underneath it, we have the calculation that converts this to a time value formula. Now for a bond, what are the cash flows? Bonds have fixed income. That means they're going to pay a coupon every year, sometimes twice a year, for a certain period of time. And at the end of that time frame, they guarantee or they plan to paying $1,000 in the principal to pay back the loan. So we know everything we need to know about the cash flows. We need to know about the timing. We need to know about the amounts, and we know all of those things. The thing we don't know is we don't know the required return. We don't know the risk element. So how can we figure out this risk element, if you will? So we need to determine the return or the opportunity cost of capital, the discount rate. So we've talked about this in previous videos. All interest rates can be broken down into these component parts. The real rate plus the inflation premium is the risk-free rate. Almost every bond has those two components. But the third components, these last three components, are really more geared towards corporate debt, especially the last two, the liquidity premium and the default risk premium. Maturity risk premium can be attached to very long-term government bonds. But we need to understand and find this opportunity cost. Well, how can we find this? There's no real formula that we can apply to calculate this for any one particular bond. So how we might do this is if you try to determine the yield or the return that investors want for certain kinds of bonds. For instance, a AAA rated bond is the safest kind of bond. If you could go out and find what the average rate of return is for a AAA rated bond, let's say it's 6%, that's the rate of return you would expect for any AAA rated bonds. All bonds, all assets of similar risk should have similar returns. So if you could find the average rate of return of a AAA rated bond, that's the discount rate that you would use for a AAA rated bond. What if it was triple B? You can find that out in the real world in data banks that tell you what the average yield is for those types of investments. So we can find this number. Now we have some basic investment rules, and I've just added this so we can kind of understand the process, right? So our first rule says if the value of an asset is greater than or equal to its price, you would want to buy the asset. So if you could go out and buy a bond, let's say you call your broker up and you say, I would like to buy ABC bonds. And he says, look, you can buy that for $900. Well, is that a good investment or a bad investment? We need to solve or figure out the value. That's what we're doing in this video, trying to determine what it's worth. So if you determine that this bond is worth $850, would you pay $850 to buy something that was worth $900? I think you wouldn't want to do that, right? I mean, so anyhow, if the value $850, if it's greater than the price, if it's worth $1,000 and you could buy it for $900, certainly you would buy it. We can apply the same rule to the expected return. If the expected return is greater than or equal to the required return, you buy the asset. What's the required return? We just said we have to figure out what that is, but we can find that in some publications. The expected return, we're going to have to calculate that, right? This, in the end, is what we're going to refer to as our yield to maturity. So let's think about how Excel can help us solve for some of these problems that we're going to do. So we need to know what variables there are. The par value is almost always $1,000. We have the annual coupon. We have the required return we've talked about, the time to maturity. Now we have to know whether the coupon is paid once a year or twice a year. So the compounding frequency is either going to be a 1 or a 2. And now here are the formulas. Over here are the formulas for our basic calculations. The bond value, right? And then we can also calculate yield to maturity, yield to call, current yield. Again, we'll talk about some of these a little bit in other videos. So let's take an example. What's the value of a 10-year, 10% annual coupon bond if the required return is 10%? So we plug on our numbers. $1,000 or $1,000 the par value, the coupon's 10%, the required return's 10%, 10 years to maturity, compounding frequency 1. You find out that the bond value is $1,000. Now, if you plug in here a price, let's say that it's worth, you could buy it for $1,000. If you paid $1,000, you would earn a yield to maturity of 10% if you bought it today and held it to maturity. Now, one of the things that you need to explore a little bit is what happens when these variables change. Now, first, once you buy a bond, there are only 2 variables that can change. The first is time, right? So if you buy this bond today, at the end of the year, there's only 9 years left. So time can change. But also the required return that investors want, they can also change because of risk elements. Risk elements in the economy, risk elements in the company. So those 2 factors can change. So if the discount rate changes, what happens to value? And we've talked about this in earlier videos. We talked about the time value of money. As the required return increases, the value decreases. So if this goes from 10 to 13, the value of this bond will fall. If nothing else changes and we go from 10 to 9, again, in this case, the bond's going to stay the same. It would stay at $1,000. And this is because it's a special kind of a bond where the coupon and the required return are equal. So there are three kinds of bond yields that we can talk about. We can talk about the current yield. This is just the coupon divided by the market price. It tells us what return are you going to earn this year if you buy the bond and you get the interest, or if you know the value, what's the return you get this year on the investment money that you earn. Yield to maturity, we've already talked about that. That's the yield or the return you get if you buy today, hold to maturity. The yield to call is the return you would receive if you buy today and the company calls the debt at the first opportunity to call. So let's see some more examples. So we have a coupon of 12%, required return of 10, time and 10. What's the value of this bond? The value of this bond is $1,122, right? So that's the price you'd be willing to pay for this bond. If you change the coupon, if it was 8% instead of 12%, plug in the numbers, you would find it's worth $877. Now, you should play with these variables a little bit and see what happens when you change them, right? Again, what happens if we said that the required return goes from 10 to 7, what's going to happen to the value of these bonds? If the required return goes down, the price is going to go up. So one of the features that we need to kind of understand is what happens over time to bonds. And we can think this through, right? This is a 10-year debt. At the end of 10 years, they have to pay you the value of the loan, which is $1,000. So what is it going to be worth in 10 years? It has to be worth $1,000 regardless of what it's worth today. So as we see, both of these bonds are going to mature at $1,000. You can buy a bond today at $877. This was the discount bond, and eventually it'll be worth $1,000. Likewise, if you bought the bond at $1122 today, eventually it would be worth $1,000. Now, without getting into a lot of detail here, the idea of fixed incomings is you know exactly what you're going to get and it doesn't change. So people that desire high cash flows, they need high coupons, are typically going to be willing to pay for them. So they'll buy bonds at premiums because they get more cash flow. Now, those things ultimately will sell for a capital loss because they have to mature at $1,000. Likewise, other investors may not be so interested in cash flow, and they will be willing to take lower coupons. So they'll buy them at a discount, and eventually they'll get a capital gain because eventually, again, it has to sell for $1,000. The next thing to talk about, again, is this concept of yield to maturity, and I've switched the bond here. So now we have a 30-year, 9% coupon bond that's currently selling for $887. So if we plug in our information, right, $1,000, 9% coupon, required returns 10%, although we didn't need that. 30 years is the time to maturity. compounding frequency is 1, and here's the price, $8.87. This bond was currently, the value of this bond is $905. That's what it's worth to you. You can buy it for $8.87. Would you pay $8.87 to get something worth $900? Absolutely you would, right? The value is more than the price. To look at the yield to maturity here, you can also see what the yield to maturity is 10.22%. So if you bought the bond at $8.87, it would mature and you would earn 10.22% annualized over the life of this bond. The last thing to think about in this video is how do we do this with the yield to call? So in this particular bond, again, it's the same bond, but now it has a call date of 10 years. And the call premium, the amount they're going to pay you, is the par value plus 1 year's interest. So if we plug that in here, we know the yield premium, 1090, time to call is 10. So the yield to call here is 11.48%. So here we have our three yields calculated for us. Very first year, you make 10.15%. Annually, though, you're going to average 10.22 if you hold it for 30 years. But if the company calls it in 10 years, you'd actually earn 11.48%. So as an investor, you have to think, well, what do I know about interest rates? Are interest rates likely to fall or increase? If you think they can fall, the question then is, do you think they'll fall far enough so that the value in 10 years will be more than $1,090? Because if it's worth more than $1,090, the company is going to call that debt. But that means you would actually earn 11.5%. So if you think interest rates are going to go, this is a good bond, because if the company does call, you'll earn a higher return than if you hold it for another 20 years. So I hope this video helped a little bit. Look forward to seeing you in the next one.